Steve, thank you for that introduction. Good afternoon, everybody. As Steve said, my name is Daniel Grange, and I'm one of the tax partners at Spofford. So the plan for this afternoon, what I'm going to talk to you about, is really to give you an overview of three key tax areas that are going to affect you as landlords. So we're going to look at the tax treatment of any income that you receive, what the tax position might be when you come to sell the property, and then think about inheritance tax if you're owning the property when you pass away. So we'll come on to those in a bit, but first we really need to think about how you own the property. That's going to affect how you're taxed and also how the asset might pass on your death. So if we're thinking about personal ownership, you can obviously have it in your sole name, and if that's the case, then you're taxed on all of the income as it arises, and you're taxed on all of the capital gain. And that's very straightforward. If you're owning the property jointly with other people, then there are a couple of ways that this can be structured. You can have it as joint tenants or tenants in common. And if the property is held 50-50, from a tax perspective, there's pretty much no difference. The important thing, though, if they're held 50-50, is the way that they pass on your death. If you hold the property as joint tenants, your share of the property will automatically pass to the other owner of the property, irrespective of what it says in your will. Whereas if you own the property as tenants in common, then your share will pass under the terms of your will, so you can leave it to somebody completely unconnected with the property at the moment. So if you do own the property as tenants in common, it's going to be really important that you've got a will in place and that it accurately reflects your current wishes. I said that the tax treatment pretty much flows if you're 50-50 owners, and that's absolutely right. But the opportunity that we have if you're owning the property as tenants in common is that you can own the property in different proportions. So you could perhaps have it 90-10, and that then means that the income is split 90-10, and also when you come to sell the property, those proceeds are split in the same way as well. And that can be really beneficial if you've got the property and you own it jointly with somebody and your rates of income tax are lower than somebody else's, that you can put the income into the hands of the person who's paying tax at the lower rate of income tax. And it'll also mean that when you come to sell the property, the capital gain that's realised is also split in those proportions. And again, that can result in some significant tax savings if the gain is realised by the person paying tax at the lower rate. What's really important, though, is that those basic rules are overridden where the joint owners are husband and wife. If you own a property jointly with your spouse, even if it's in different proportions, so 90-10 or 75-25, the revenue will automatically tax you on that rental income split 50-50 equally between the two of you. There is a way around that, but you have to make an election, you have to notify the revenue, and you have to sign a particular form that has to be filed with them. So you need to take care that that form is filed. It's not good enough that you just split the rental income on your tax returns and hope that it sorts itself out like that. The other thing with tenants in common is that you can change the proportions later on. So maybe that you buy 50-50 and then you transfer it later on, and we'll come on to what the implications might be of that in a bit. So joint ownership may sound like a relatively straightforward thing, but we do need to think about the type of ownership and then the split between the respective owners to get the tax position as advantageous as possible. I'll come and talk about trusts in a bit more detail later on when we're thinking about inheritance tax planning. But it's just really to highlight the fact that trusts are liable to income tax in the same way as individuals. They have their own regime, but the principles that I'm going to talk about in a minute apply in exactly the same way. And the final type of ownership I wanted to talk about this afternoon was owning properties in a limited company. And limited companies are a vehicle, an entity in their own right for tax purposes, and they generally pay corporation tax on profits at 20%. And as we'll see, that can be significantly lower than the rates of income tax that you might be paying on the rental income that you receive. So owning investment property in a limited company can give a significantly lower tax bill on the rental income that's received. So if you've geared up, if you've borrowed to to buy the property, owning a property in a company can give you a good way to pay that debt down quickly out of post-tax income. The downside of using a company, though, is that there will be a double tax charge potentially when you come to sell the property and you want the money in your personal hands. You have to pay corporation tax on any profit, on the capital gain you've made, and then you have to pay personal tax when you extract that money from the company. So there are swings and roundabouts, really, advantages and disadvantages, but in the right circumstances, a limited company can be very, very efficient, but you've got to think about the longer term tax implications as and when you come to sell the property and want the money out. I'm not really going to talk much more about limited companies. It's going to be focused on personal ownership, because I'm sure that's the vast majority of you here in the room. Yeah, so we're going to talk about income tax now for individuals, and whether that's either in sole or joint names. The same principles really apply. So the first step, you found a rental property and you started letting it out. We need to think about what the income tax implications are for you on the rental income that you're receiving. So we have to look at the gross rent that you receive, and then we can take off any expenses that are incurred wholly and exclusively for that property business. So that would be things like letting agents' fees, insurance, and effectively the net figure is what is subject to income tax. And the rate of income tax that you suffer will depend on your total income. So it can either be 20%, which applies up to total income of approximately £41,500, 40%, or 45% of your total income is more than £150,000. Something that's worth looking out for is if your income is just over £100,000, between £100,000 and £120,000 or so, you'll be paying an effective 60% tax on that £20,000 of income. So if you're in that bracket, you really do need to think about some planning and working out ways in which you can mitigate that liability. So those are the general principles. I did just want to touch on 2 or 3 specific issues that I think are worth highlighting. It's possible to offset any mortgage interest that you're paying against the rental income that you receive. So you've taken out a mortgage to buy the property, you can take off the interest on that mortgage from the rental income. Some people make the mistake that they think they can deduct the capital repayments, and that isn't the case. So we quite often see clients who come in and say, yes, I'm letting this property, I'm not making any profit, I've got no cash left at the end of the year, I haven't got any tax to pay. But they're taking account of the capital repayments in that situation. So you might have a tax profit, even though you've got little or no cash profit available in your bank to pay that. So you do just need to think about that when you're planning your affairs and thinking about the future tax liabilities. Just one point there, you can get tax relief on mortgages up to the original purchase price of the property, or the value of it when you first made it available for letting. So if you've got a property that you're letting out, you could think about whether there's a more tax efficient way to have your borrowing, whether you can replace your borrowing on your main residence, either wholly or in part, with a mortgage against your rental property, and then you're effectively getting tax relief on your personal mortgage. So just things to think about there. You can also deduct any repairs that you incur on the property. So if a tenant's left and you have to go in and do cleaning or put down a new carpet, or over time you need to put in a new kitchen, then you can deduct that from your rental income. But you can't claim tax relief for any improvements that you carry out on the property. So if you put a new conservatory on or you build an extension, then that's a capital improvement, and you'll only get tax relief for that when you come to sell the property. You can't set that up against your rental income on an annual basis. And finally, I just wanted to touch on the wear and tear allowance or the renewals basis. And if you're letting a property that's furnished, so somebody can move in, who's got beds, sofas and all the rest of it in there, then you can decide whether you choose the wear and tear allowance or whether you choose the renewals basis. The wear and tear allowance is an annual 10% deduction that you can claim, whereas the renewals basis says that you claim tax relief as and when you go out and replace those items. So you just need to think about the nature of your property, the nature of your tenants, and which of those is likely to give you the most beneficial tax position going forwards. So we've let the property for a number of years, and we're now thinking about selling, perhaps to change your property, or you've come to retirement and you're looking to use some cash for something else. So we need to think about what the capital gains tax position. The important thing here is that capital gains tax bites when you sell a property or otherwise dispose of it. So if you decide to give the property away to your children or grandchildren, that can give you a capital gains tax liability, even though you haven't realised any cash proceeds to pay that tax bill. So you just need to think about that. And the essence of capital gains tax is that you get taxed on any uplift in value since you acquired the property. So it's only that profit element that's liable to capital gains tax, not the full sales proceeds. But you get relief for any enhancement expenditure and also costs associated with the purchase and sale. So any legal fees and stamp duty on the purchase, and legal fees and agents' fees on the sale. And you'll remember that when we were talking about income tax, you can't claim tax relief for improvements, so the conservatory or the extension. It's when you come to sell the property that you then get tax relief for that expenditure. So that's where it would come into this calculation. Just something that's worth noting on that, you only get tax relief for any enhancement that is present in the condition of the property when you sell it. So if you've built an extension and then knocked it down, and then go and sell it, you obviously can't claim tax relief for the cost of building that extension. So we've worked out what the gain is on our property, and then we can deduct the tax-free annual exemption. At the moment, that's £10,900, and each individual has that exemption. We've then got a figure that is the taxable gain, and that is then either taxed at 18% if you've got any of your basic rate tax band available, or 28% if you exceed the higher rate tax threshold. And the basic rate tax band is just over £32,000. Okay, so we ignore the personal allowance that we've got from an income tax perspective. We look at your taxable income. If it's less than 32,000, you get some of the gain taxed at 18. Otherwise, it's going to be taxed at 28%. And again, do just remember it's only on the gain that is taxable. So just a couple of planning points really, and things for you to think about, and some opportunities that might present themselves if you're thinking about selling a property. The first one is intra-spouse transfers. One of the fundamental principles of our tax system is that you can transfer assets between husband and wife, civil partners, without incurring a capital gains tax liability. Effectively, if I transfer a property to my wife, she takes on my base cost, so what I paid for it. So the clear advantage there is if I own a property in my own name and I'm going to go and sell it, if I transfer it into joint names, we both get a capital gains tax annual exemption of £10,900. So just by making that simple transfer, we can save £3,000 of capital gains tax. If my wife isn't using her basic rate band at all, she's not working, for example, then by making the transfer, she will get £32,000 or so, taxed at 18%, rather than it being taxed at 28% in my hands. So that can potentially save another £3,200 of capital gains tax. So by a simple transfer of half of the property or proportion of the property to my wife before sale, we can potentially save £6,200 of capital gains tax in a relatively straightforward and low-cost way. If either of you have got capital gains tax losses brought forward, perhaps from earlier property investments or an investment portfolio, then those losses brought forward can be offset against future capital gains as well. So it's just making sure that you match capital gains against losses that are brought forward. So we've thought about intra-spouse transfers from a capital gains tax point of view, but we also could think about it from an income tax point of view as well. So in my example, if I'm a higher rate taxpayer, but my wife's not working, for example, I could transfer the property into her name, and then the rental income would be received by her, and perhaps use her personal allowance, so not be taxed at all, or be taxed at 20% instead of my 40% rate of income tax. So it really is worth thinking about the split of ownership particularly between spouses, where you can transfer assets without any tax liability. The other thing I want to talk about from a capital gains tax perspective is main residence relief. And I'm sure that most of you are aware that if you live in a property for the entire period of ownership, when you come to sell that property, you will not have a capital gains tax liability. So there's an exemption for the actual period of occupation, so the actual time that you've been living in that property. So normally that means if you buy a house, live in it, sell it, no capital gains tax and nobody thinks anything of it. But the relief is actually very generous, and it says that if you've ever lived in the property as your main residence, that actual period of occupation is tax-free, but so are the last 3 years of ownership. So if I buy a property today, live in it for a year, move out for a period of time, and then later sell it, the last 3 years of ownership will be exempt from capital gains tax, even though I have not been living there. And it gets even better when you're thinking about property that you've let, because for the period that is potentially taxable, then you can claim something called lettings relief, and that can be up to £40,000. And that's £40,000 per owner, not per property. So again, if I own a property jointly with my wife, then potentially we can qualify for up to £80,000 of lettings relief, and so exempt significant amounts of gain from capital gains tax. What's really, really important here is that in order to be able to claim main residence relief, the property actually has to be a residence. You have to have lived there. You can't just sign a bit of paper and say, yes, treat that as my main residence for tax purposes. You actually have to show that you do live there, even if it's only at weekends or on a holiday basis. And where you have more than one residence, you can elect which of those is treated as your main residence for tax purposes. So I'm sure you'll remember a number of years, or a few years ago, there was the issue of MPs flipping their homes and claiming lots of tax relief. Well, that's exactly what they were doing. They were making elections as to which of their houses was treated as their main residence for tax purposes. And that's completely legal, and it's what we advise our clients to do on a fairly regular basis where it's possible. And they could do it because they had a home in their constituency that they lived in, perhaps at weekends, a home that they lived in London during the week, so they had 2 residences, and they could choose which of those was their main residence for tax purposes. You can make that election, but the property's genuinely got to be a residence that you occupy and live in. So finally, I wanted to talk about inheritance tax. Not the cheeriest of subjects, but I think it's quite important to have an awareness of it and think about it, at least on a long-term basis. Inheritance tax is generally charged on death, and that's what I'm going to talk about. And it's charged at 40% on the value of your estate over and above the inheritance tax nil rate band. And that's the technical term for the threshold, the amount of assets that you can have before you start paying tax. And that's currently £325,000. That's frozen until 2018, and once we get there, that level will have been the same for 10 years. So despite the fact we've had inflation, increases in the property market, that threshold has stayed the same. So more and more people are being caught by inheritance tax. And just to paint that, sort of put a bit of flesh on the bones of that, if we're looking at a married couple and they've got a combined estate of £1 million, there will be inheritance tax of £140,000 payable on their combined estates. So we are talking significant sums that could be due in inheritance tax. When we're calculating the inheritance tax payable on somebody's death, we don't just look at their estate at the time that they die, we also have to look back and see whether they made any gifts in the 7 years leading up to their death. If they have, then those get added back in and effectively either use up their tax-free allowance or get charged to inheritance tax at that time. So inheritance tax planning generally involves giving assets away at a point in time when you think you're going to live for at least 7 years, and then that value can fall out of your estate for inheritance tax purposes. One development or change that happened about 5 years or so ago now is that you can now transfer the inheritance tax threshold, that £325,000, between spouses. So that means if I die and leave all the assets to my wife, on her death, she would get £650,000 of inheritance tax allowance. Previously, you had to draft your will with a will trust in it to get the benefit of that double nil rate band. So just worth thinking about. And if you've got wills with those nil rate band trusts in, it may well be worth reviewing them and seeing whether they're still the best route to follow or not. So I just want to touch on a couple of the options in terms of inheritance tax planning and things that you might think about. As I said, the main or the easiest way of inheritance tax planning is giving assets away when you think you're going to live for 7 years. And there are a couple of ways that you can do that. The simplest way is making an outright gift. So I've got a rental property and I could decide to give that to my son, for example. And assuming that I live for 7 years after the date of the gift, that property will not form part of my estate for inheritance tax purposes. So it will not be taxed, subject to inheritance tax when I die. The downside is, though, that, as I mentioned earlier, if you give away assets, you're treated as selling them. So you're treated as receiving the market value of those assets. So there could be a capital gains tax liability. So you have to pay capital gains tax even though you've received no cash proceeds. So you obviously need to think about that. The other thing is that you're giving away the capital, which is what you want to do because you want to reduce your inheritance tax liability. You're giving away the income, but you're also giving away control. So do you trust your son, daughter, grandchildren to keep that property, use it sensibly, or do you think they might sell it and go and buy a fast car or a yacht or something silly that you don't approve of? By giving them that property, it's their choice and they can do what they want with it. And there's a lack of flexibility by making an outright gift. As soon as you've done it, it's gone to your son, daughter, whoever, and that's set in stone. And you can't change who can benefit from that property over a period of time or that asset over a period of time. I think it's just worth making the point that there's no limit on the amount of or the value of gifts that you can make outright. There's a bit of a common misconception that there's a limit of either £3,000 or £325,000. That's not correct. You can give as much as you like away, and as long as you don't die within 7 years, those assets are completely exempt from inheritance tax. The really important point here, well, two really important points here. If you give away a rental property, you can't continue to receive the income. Lots of people say, can I give that away and keep the rental income? No. There are rules to stop that. If you give an asset away, you can't have any ties or any benefits from that going forwards. The other issue to think about where you're looking at property and giving that away is if the property is subject to a mortgage, then potentially there will be a stamp duty land tax charge for the person who's receiving the property based on the outstanding mortgage liability. So you may not have a capital gains tax liability depending on what's happened to the value of the property, but you may well have a stamp duty charge if you've got a mortgage on that property. An alternative to making outright gifts is to transfer properties into trust. This is slightly more complicated, but as I'll come on to, there are some significant benefits of doing this in the right circumstances. As long as you give away less than your available inheritance tax threshold, there is no inheritance tax payable at that point. And assuming you survive for 7 years, again, the value of that gift falls outside of your estate for inheritance tax purposes. If you give away more than the inheritance tax threshold, so more than that £325,000, then there's an immediate inheritance tax charge of 20% on the excess. So you do need to be careful on the amount of money or the value that you're putting into that trust. The assets within those trusts do not form part of any one individual's estate for inheritance tax purposes. Trusts are instead subject to their own inheritance tax regime, with a tax charge every 10 years at a maximum rate of 6%. So no tax when anybody dies, but this recurring charge every 10 years at 6%. One of the real benefits of using trusts for inheritance tax planning is that you can elect not to pay capital gains tax at the point that you transfer the asset. So as I said earlier, if I gave a property outright to my son, I would potentially have a capital gains tax liability. If instead I transfer the asset to a trust, I can elect to defer that, and the tax is only payable as and when the property is actually sold by the trustees, when there's cash available to pay that tax. Using a trust in this way, you give away the capital value, which is what we want to do from an inheritance tax point of view. You have to give away the income, but you can retain control. And the way that works is that you can be the trustees of the trust that you set up. So you can decide who gets the capital value in due course, whether the property's sold, and who benefits from the income. So there's no risk of giving the property away to your son and he goes off and buys a fast car and goes sailing around the world. So you can retain that control. And there's also flexibility over who can benefit in the future, because you can have lots of different beneficiaries of the trust, and you can decide who benefits from that asset or the income over time. So maybe that you have grandchildren going to university, and they're staggered conveniently every 3 years, where you could support one child through university for the first 3 years, then the next, then the next. So you're not setting in stone at the point you transfer the asset who's going to benefit either at that point or at any point in the future. So trusts can offer a huge flexibility and a fantastic way of avoiding or mitigating your inheritance tax liability. That's it from me. A bit of a brief overview of the key tax issues, really. I think I've highlighted that there are some potentially very significant savings if you arrange your affairs well, but on the flip side, it can be very expensive if you don't. So I would just suggest that you get good professional advice before taking any active steps.